The information contained in this podcast is provided for informational and educational purposes only and should not be construed as investment advice, an offer to sell, or a solicitation of an offer to buy any securities, financial products, or investment services.
I'm Adam Walter, and welcome to the Y'all Street Podcast.
I'm Dale Walter. Adam, please tell us a little bit about this podcast and your vision for it.
Well, today is January 5th, 2025. It's been about a month since we did the last one, so we're going to stick to the script and talk about a little bit about what we talked about last time. We're going to talk about Dallas and some of the places that we've been going around town, and then we're going to talk about the markets and some of the current events and investment ideas that we see.
My name is Dale Walter. I'm the VP of Business Development at Walternative LLC. I'm Adam's father. I live in California. I have worn many hats over the years. I was a software engineer for 25 years back in 1981 through 2005 in Silicon Valley, working in the semiconductor business. I've been in the construction business ever since. Tell us about yourself, Adam.
I'm Adam Walter. I'm CEO, founder of Walternative. I am an investor and an author. I have an upcoming book I'm working on with Forbes. And we're working on some hydrogen consulting and grant opportunities in California right now as well.
Okay. You mentioned previously that Dallas has a lot of really good restaurants. I was craving paella recently, and you took me to a nice tapas restaurant called Cafe Madrid. The paella was outstanding, and so were the mussels. They also had a live guitar player who was quite good. It was downtown, not far from where the Texas Stock Exchange is going to be located. What was the name of that district?
It's the Knox-Henderson area of town. So really close to SMU. We had our offices there up until very recently. And a pretty hip, kind of trendy spot in town. They're building a brand new high-rise hotel right there next to Cafe Madrid. So traffic is kind of rough, but we've been there before. It's an excellent spot. I highly recommend it.
I hear the Texas Stock Exchange is planning to move into a temporary office space this spring in Fortress Investment Group's lease space in Weirs Plaza.
Yeah.
A modern office tower in the Knox-Henderson district.
Yeah, I mean, that's right there. I mean, it's a relatively small part of town, but it's close to downtown. I think the actual Texas Stock Exchange is going to be downtown, but this is just where their corporate offices are. So they made headlines on that this week.
Yeah, I hear they're still looking for a permanent home for their executive headquarters and market center.
Yeah, we're still trying to figure out where Y'all Street is exactly. Right now, it's more of an idea than a physical place, but I think we're going to have to rename a street Y'all Street at some point.
They're also planning a Texas Market Center that will feature a broadcast studio, conferencing center, and a Texas Business Museum.
Yeah, I mean, it's going to be near the museum district. I think it's going to kind of transform at least part of downtown. I don't know exactly how and where, but it's going to be probably towards the end of this year in 2025. That they'll go live with that. So, yeah, we want to be a part of it and be as close to it as possible.
In the last podcast, you told us about a cigar lounge where you met Dennis Rodman. Was that the Blue Smoke?
No, but we went to the Blue Smoke this last week.
Right.
That's pretty close to where I live, so.
Yeah, it was nice.
We like that spot. Much smaller than that other spot. That was Casa de Monte Cristo, I think is what that one's called. But the Blue Smoke is a little bit more, smaller, laid back kind of vibe. We went there. We watched the football game. Right? What was that? Tuesday night?
Yeah, that was
Monday night football.
I think so. Yeah.
What'd you think of it? Did you like it?
Oh yeah,
Blue Smoke.
Nice place. Very comfortable. Big, huge leather chairs.
Yeah.
TVs everywhere.
Front room and a back room. You wouldn't know the back room was there if you didn't walk back, but a couple different humidors in there. Yeah, it was cool.
Nice place. All right, well, let's get to our main segment here. Talk about the stock market overview. How about oil? Oil prices are moving back up to $74 a barrel, highest they've been since mid-October. And the oil and gas sector is up 3.5% already this year.
Yeah, I mean, the whole energy sector has kind of been beat down, for the last year or two, even in the midst of a large market rally. So I think I read this is some of the best 2-year streak since like the 1990s in the market, the last 2 years. But energy has not really participated. So part of that is the price of oil. Oil's been down on demand concerns from China. They're addressing part of that with some stimulus measures now. And then I think with Trump and his administration coming in, there's just a sense that he's going to do something for the oil and gas industry. So yeah, that was actually the top performing sector in the market last week. And then if you look at, some of the top performing names here, I've got a couple utility companies that made the top 10 here this year, which is pretty surprising. Vistra Energy, which has nuclear, solar, coal energy, was up 274% last year.
Wow.
If you could believe that. Talon Energy, which is another utility provider, was up 222%, number 16 on the list of top 100 companies performing in the market last year. And then just a couple other names that caught my eye, but GE Vernova was up 160%, number 34. Veritiv, VRT, which provides some of the power for the data centers and cooling for those GPUs, was up 147%, number 40. And then Constellation Energy was number 99, up 95%. So a lot of really strong performance in some of those companies last year. Unfortunately, rounding out the bottom of the list, PBW, the Invesco Wilder Hill Clean Energy ETF, was at the last spot, down 26% last year. Same with some of the other ETFs that we track. So iClean, the global iShares Clean Energy ETF, was down 24%. Alps Clean Energy ETF ACES was down 23.9%, and then Invesco Solar ETF TAN was down -35%. So you got to take the good with the bad a little bit, but I think energy is a little bit of a contrarian play right now. I think like we talked about last time, tech has been so strong. I think we're seeing a little bit of rotation, and I do think if the market's going to continue to rally higher, we need to see some of these other sectors start to, take the lead. And it'll be interesting to see, how the clean energy sector does under Trump. So,
as far as the major indices go, the stocks ended 2024 near record highs. The Dow is up 0.44% this year already, after rising 14.08% last year. S&P is up 1.09% year to date, after rising 26.5% in 2024, and the Nasdaq is up 1.61% this year to date, after rising 35.1% last year.
Yeah, I mean, just outstanding performance last year for all the major indices. Now, something a little concerning is just the fact that it's really mostly the Mag 7 that have been driving this, right? I mean, there hasn't been this high of a concentration in such a small number of stocks since the 90s.
So the breadth is not there.
Right. So that's a little concerning, because I think if you want to see sustainability in the rally, you want to see some of these other sectors, also partake in that performance, right? NVIDIA, Apple, Meta, Google, they can't hold up the market forever. And in fact, if you're looking at the performance of the index and it's, 40% is in 7 companies, like that's not representative of the other 493 companies on the index, so
Right.
You want to see those perform as well. And so that's a little concerning. But I think, markets are pretty much right back to where they were after the election. So been a lot of up and down over the last month or so, 2 months, but we'll see. The market was kind of sideways last week, and then it bounced on Friday. So hopefully, it bounced off the 50-day average. We'll see it continue.
Yeah, we didn't really get the Santa Claus rally that we were
no
hoping for.
Everybody got a lump of coal for Christmas from the markets. It was the Grinch rally.
Right, that's more like it. Well, let's talk a little bit about current events. They say it takes a network to unleash the powers of AI, and the companies that supply networks are seeing their stocks soar, like Broadcom, Cisco, Arista, Marvel. They stand to get a growing portion of the billions spent on AI data centers.
Yeah, I mean, again, this AI sort of mega trend is really playing out. Like I said, the utility companies have been in the top 10 and super strong performance last year. Just another example, Entergy was up 47%, and Meta announced that they're going to invest $10 billion into the largest largest data center in Louisiana. They're going to take 3 natural gas plants to power that one data center.
Wow.
So yeah, I mean, McKinsey came out and said that data center consumption in the U.S. is projected to grow from 4% of total electricity demand this last year to 11 to 12% by 2030.
Wow.
So I mean, this is just
Almost triple.
huge demand. Yeah, I mean, and this is front page news. It seems like every other day. I got an article here from the Wall Street Journal that says that after 2 decades of little to no growth in power demand because of efficiency gains, electricity usage forecasts have skyrocketed in many states because of the spread of AI, EVs, manufacturing, and broader electrification efforts. So, we're in an interesting spot right now where I think, demand is just off the charts, right? It's going through the roof. And what's going to be interesting is to see how does this play out in terms of, right, if you need more and more and more power, you're going to need all the available sources you can get, right? And even though the Trump administration has come out and said, they favor oil and gas, right, and more of those traditional sources, I don't think they can afford to do away with the tax credits from the IRA for wind and solar or any of these other clean technologies, right? So, it's just the key is demand. There's just more demand than anybody thought that we would ever possibly have.
And it's just going up.
Exactly. It's a huge step change. They likened it to the introduction of air conditioning.
Right, yeah.
So, I mean, I don't think people really have an idea of the scale of the increased demand that this is causing. I mean, you could read the statistics, but it really just,
Well, I'm sure the average person has no idea.
Yeah, I mean, it's so then that's why you're seeing all these stocks rally, right? So,
So we're 2 years into the bull market now. The S&P is expected to keep growing 15% this year over last year, driven by earnings growth.
Yeah, I mean, earnings is what's going to drive the markets, right? It's not so much tariffs. It's not, headlines out of China. It's not any of that stuff, right? I think the market is still got room to run, but, AI is still very much an unknown, right? I mean, how much is that going to translate into more earnings per share in the near term, right? And I think you see that with the earnings reports that some of these companies have been coming out with recently where, they're being punished if they spend too much. I mean, you need to spend a lot capital expenditures on this stuff in order to be at the forefront of the technology. But if you spend too much and you don't have enough earnings to show for it, you're still going to get punished. So it's kind of a damned if you do, damned if you don't scenario. But companies are trying to thread that needle a little bit right now.
Well, let's talk about hydrogen. I understand there was a big news on Friday in the hydrogen space. What was it?
Yeah, absolutely. So the Treasury Department and the IRS came out with a joint statement that is the final rules for the 45V clean hydrogen production tax credit.
Oh,
This is what was established by the IRA and the Inflation Reduction Act.
been waiting for those for a long time.
Oh my gosh, like years, So it finally came out, and the headline is that they provide more flexibility for investments and ways that you can generate hydrogen. So they've opened the door to nuclear energy actually to be able to partake in the hydrogen production tax credit.
Wow.
So they've relaxed some of these rules, which is I think it's a net positive for the industry, right? There's still the concept of a variability to the amount that you're going to get. In order to get the highest amount, 100%, $3 per kilogram, you're going to have less than 0.45 kilograms of carbon dioxide equivalent per kilogram of hydrogen. And then it goes down from there. So if you have 5 kilograms CO2, you get 33%. If you have 5 kilograms per 1.5 kilograms of CO2, you get 25%, and then the lowest is 20%. So for the most part, it's 20 to 30%, but to get 100%, you have to be extremely low on the carbon intensity score, which is good. But, again, we saw some of these nuclear names rally Thursday and Friday of last week in anticipation of this news. And I think they're just going to continue to rally because everybody wants to participate in this.
Nuclear energy-related stocks have taken off following announcements from Alphabet, Google, and Amazon as the tech industry turns to nuclear energy to power AI data centers.
Right. Yep. Yeah, but nuclear energy is low carbon. It doesn't emit that much in terms of CO2 or any of these other pollutants into the atmosphere today. So, like I said, it's kind of a land grab for all available resources right now. Natural gas, nuclear, you name it, right? They're going to go after everything that they can to power these data centers right now.
What about the January effect? What is it? Is it real?
The January effect is definitely real. I mean, it's basically speaks to a phenomenon where, at the end of the year, there's what's called tax loss selling. So people will sell the worst performers in their portfolio because then you can take the tax, offsets essentially from your tax bill to Uncle Sam that year, right? So if you've got a loser in your portfolio and it's called tax loss harvesting, you just kind of use that to offset gains in the rest of your portfolio. So the losers get sold off, and then with window dressing with other portfolio managers, the winners keep winning, right? So, and then what happens in the January effect is sort of the opposite. The January effect is where if people sold off things at the end of the year and they got killed and then they got oversold, those tend to rally in January.
Yeah, the market tends to overreact usually.
Typically, yeah. So, and I think my former employer, Plug Power, who's a beneficiary to this whole 45V tax credit thing, is one of those stocks that had underperformed last year and got sold off at the end of last year. But fundamentals have improved a little bit recently, and now with this news, they were up pretty good last week. So
it's interesting. The best performers so far this year, utilities, up 1.32%, and the NASDAQ is up 1.61% this year to date.
Yeah, I mean, it's going to be interesting to see, like I said, how this plays out. I personally think that the tech trade is just a little overcrowded, and that I think we need to see some new leadership. I mean, if you look at some of the PE ratios of, like say take Tesla for instance, that it's had a great rally, but the PE ratio of that stock is at 99, which is just insane, right? I mean, you're up incredible. In the stratosphere, so hard to justify that type of valuation at $420 a share. Whereas you look at, Chevron has a PE of 9 or 11, and it's got a dividend yield.
What's the average? About 19?
For the S&P right now, it's over 20. It's like 21 or 22, I believe, which is historically pretty high. So again, that's why I think, when you're looking at, if you're investing in the market right now, like know what you own, you're buying at historically high valuations. It doesn't mean that the rally can't continue, but, the Fed just started scaling back their rate cuts, right? They did a hawkish cut in December. Markets sold off pretty hard on that. So, Wall Street's very much always ahead of the curve, buy the rumor, sell the news. And the Fed is not committing to any more rate cuts right now. Nothing's on the table. They're going to take their sweet time. And so, they're the sugar bowl is, they're taking the sugar out of the punch bowl now, so we'll see.
Well, some of the worst performers have been consumer goods. They're down 2.33% past week. Basic materials down 1.91%. Consumer services down 0.65%. Tech is down 0.51%. Telecom 0.39%. Industrials 0.2 and financials 0.11.
Yeah, I mean, this is rotation, and you kind of expect to see this at the beginning of the year, right? I mean, people are repositioning their portfolios, and like I said, a lot of those companies that had outperformed, they're getting sold off because 2024 is in the books, right? It's a new year, and now it's time to reposition our portfolios for this year, right? You've got a new presidential administration incoming in January. They're going to change a lot of the rules to the game when it comes to tariffs and energy policy in particular, investing. So that's going to have a wide range of consequences for everybody.
Back to hydrogen, you recently flew out to California. Saw some Shell stations out there, hydrogen stations, to see some Shell stations. And
Yeah.
they had dismantled all their light-duty hydrogen stations that they had built only a few years earlier.
Yeah, that was a bit of a disappointing trip, to be honest with you. I mean, I had been talking with a real estate broker and about potentially leasing one of those stations in Sacramento. And by the time I got out there, we took a look at it, and it was gone.
Yeah, we got there while they were still digging it up.
Yeah, they were literally repainting the canopy, and if you didn't know it was there, you would have no idea. I mean, they repaved over it, and then we went to another one crosstown, and that was actively under construction.
Right.
Or demolition. Right. I mean, so
It
it's disappointing. I mean, those Shell built like 6 hydrogen stations. I think between like 2014, 2015, 2016.
2019 was when they opened the one in Sacramento.
Okay, yeah. So it wasn't even that long ago. Yeah, I mean, they operated for maybe like 2 or 3 years.
And they had a lot of problems too. They were down more than they were up. They had problems with supply. They had problems with demand.
Yeah, so kind of what happened there, just a little bit of backstory is, Shell went with a company called Nel, which is a Norwegian company for their technology for the hydrogen stations. That Nel actually sells
the equipment.
Yeah, they sell a package that's called the H2 station, and they and others beyond just Shell, everybody went with that technology back when they had this last round of grants. And unfortunately, like you said, I mean, they just didn't work. And so they had tons of issues. They were plagued with, downtime, and they kept sending technicians out to try to fix it. They couldn't fix it.
Well, they weren't even ready to go out, I heard, when they started selling them. They
Right.
hadn't really completed full testing.
Yeah, Shell sold everybody a bill of goods. I mean, sorry, Nel. Nel sold everybody a bill of goods. It didn't really work. So they were a little out over their skis on that. And then, it's a big black eye on the industry, right? Because I think there was a lot of fanfare. There was a lot of opportunity. And instead, what's happened is just everybody's got a bad taste in their mouth now. So.
Oh, yeah, the hydrogen car owners felt really, hung out to dry there. Like they'd been misled.
Yeah, and, from my perspective, I mean, I've spent so many years of my life building hydrogen infrastructure. I know what it takes. It's very time-consuming. It's capital-intensive. And to just throw the baby out with the bathwater like that, it just seems extremely short-sighted. I mean, you could have done a lot of different things to keep those things up and running. Like I said, I would have been willing to step in and buy or lease one of them and try to fix it. You can replace components. You can replace pumps and vaporizers, compressors, whatever you need to do. But I think the way that they had structured that deal was Nel retained all the rights to the service of the equipment, and they wouldn't let anybody else touch it. So Shell didn't really have much of a choice. And so they just said, enough is enough. Shut it down. Their new CEO came in, and he's very much focused on their core business, which is oil and gas, exploration, refining, and he wants to return the company to profitability. And you can't really blame him. I mean, if I was a shareholder, that's what I would want to see.
It's a publicly traded company.
Right. So they've completely scaled back their light duty hydrogen division. They basically laid everybody off.
Well, they took a bath, too, because they had to give back like $200 million in grant money.
Thank goodness they're giving the money back to the state of California. Yes, because
Yeah, but that means that all that money they laid out up front, expecting to recoup half of it at least.
Yeah.
Now they're stuck holding the bag.
Yeah, like I said, the whole thing's kind of a black eye on the industry. So too bad. That was sort of the first or second wave of development of stations out there. But, it's okay. The next generation, the next wave, I think, is going to be cleaner, greener, better technology. Hopefully, maybe even some U.S.-based technology companies for the hydrogen systems as opposed to Norwegian companies. And maybe it'll perform better.
Let's recap a little bit here. The energy performance in 2024, the energy sector delivered a modest total return of 5.6% in 2024, reflecting a year of moderate energy prices and uneven performance across its subsectors. While upstream producers and refiners struggled, the midstream segment delivered standout results driven by strong fundamentals and dividend growth. According to data provider FactSet, midstream companies led the energy sector with an average total return of 20.8%. Targa Resources Corporation was the top performer, delivering a remarkable 110.1% return. These results highlight the segment's stability and income-generating appeal amid a year of restrained energy prices. In contrast, upstream companies, pure oil and gas producers, recorded an average gain of only 1.5%.
Yeah, I mean, the midstream segment is less dependent on the price of oil, right? I mean, they are going to make a profit regardless because they're just charging, fees for operating their infrastructure, right? Pipelines and all the rest, racks, distribution. Whereas the refiners, exploration companies, they're going to make more profit based on a higher price of oil. So, it's going to be interesting to see what happens this year. Like I said, I mean, I think there was a headline last week that the inventories in the Strategic Petroleum Reserve is less of an increase than people thought there was going to be. So, like I said, I mean, China is trying to stimulate demand. If the economy holds up and Trump rolls out some good policies for that sector, I mean, you can't argue with prices right now. Oil's going up. If it crosses $75 a barrel, I think that's bullish for everybody, not just for oil and gas, but also for, the rest of the energy sector as well.
The outlook for 2025 presents both opportunities and challenges for the energy sector. A more favorable regulatory environment under incoming Trump administration is expected to benefit oil and gas operators, but industry profits will ultimately hinge on commodity prices.
Right. Yeah, that's what I was just saying. If you have higher prices, is better profitability for the whole sector.
OPEC Plus continues to maintain production cuts. The record U.S. oil output has dampened upward pressure on oil prices.
Well, yeah, and this is what's so interesting about the whole thing, right, is because Trump campaigned on the idea of lowering everybody's energy prices.
Drill, baby, drill.
Right. So higher production would tend to equal lower prices at the pump. But, the oil and gas companies, I mean, I was reading this the other day. I mean, like you take the Permian Basin in Texas, for instance, right? I mean, these are large companies now. This is not mom and pop shops of wildcatters out there anymore that you can just push around. These companies are large public companies, so they're beholden to their shareholders. They want to see good returns, right? And they're not going to just react overnight. There's no magic lever that you can pull to just say, oh, hey, let's produce a lot more oil and gas, and then all of a sudden the prices are going to go down. In fact, what did we just say? Oil is going up right now. Mm-hmm. And that's actually better for the oil and gas companies. So it's kind of a catch-22, I think the Trump administration is going to have a hard road to hoe here to try to both, help the oil and gas industry return to profitability and lower prices for the John Q. Public. That's a tough needle to thread.
They seem to be opposite ends of the spectrum
right.
there.
Yeah. Okay, well, let's we'll see how it plays out. I think it's going to be an interesting year, 2025, if the market continues to rally. Counterintuitively, who knows? Maybe we'll see the clean energy, green energy stocks continue to rally even in the midst of a Trump administration. They did well under the last Trump administration, actually. And oil and gas did pretty well under the Biden administration. So we'll just have to keep our eye on the sectors, and we'll check back in a week or so. So we want to remind everybody, please like and subscribe. If you liked what you heard, check out our social medias. You can go on the website, walternative.net. And please leave us a comment. So I'm Adam Walter.
I'm Dale Walter.
Thanks for listening.
Thanks a lot. Bye.